Hi friends, in this video I'm going to explain the S&P 500, give you some insight into the types of companies that are in it and why it can be a great place to start investing easily and safely. Now if you're new to the channel, my name is Charlie and I'm an investor based here in the UK, and on Kowalah School we are helping young and first-time investors to start their investing journey safely and successfully. Today, we're going to take a look at the S&P 500. Now, when I started investing, I thought this is exactly the kind of cryptic phrase that is going to confuse me and make me think that investing isn't actually for someone like me. But actually, it's a really easy thing to get your head around. And if you do, you're going to find that it is a really sensible way of starting your investing career. First, let's take a look at what the S&P 500 is. It stands for Standard & Poor's 500, and it's really a list of 500 of the largest companies based in America. And the list in its current form goes back as long as 1957. Now, the companies that are on that list are agreed 4 times every year, and they're based on some key criteria. The first is they need to have a certain capitalization. That means how big they are, how valuable they are. And they need to be at the moment at least worth $9.8 billion. So it's big companies. Then they need to look at how much of their shares are traded each month. It needs to be what's called a liquid stock. Then also they need to have been founded in the United States. So it can't be a European or an Asian company. And they needed to be listed on one of the US stock markets. 500 is a lot of companies. Now you'll probably have heard of some of them, and many of them you'll have never have heard of. You're going to find companies that you know and use very much. Maybe Apple, Amazon, Microsoft, Facebook, all of these are on the S&P 500. Then you'll also find some healthcare companies like Pfizer, who are making one of the vaccines for COVID. There are big financial organizations. You might be familiar with Visa and MasterCard on your debit or credit cards. And then there are big fashion organizations like Nike, whose shoes you might wear. And then also food organizations like Kraft Heinz and Domino's Pizzas, as well as media companies like Walt Disney. There really is a very wide range of very well-known organizations that make up this list of 500. Now, one of the things to get your head around is the fact that the index is weighted by the value of the companies that are in it. So a company that is worth 10 times more than another one will be represented as 10 times more in the index. So let's take a look at the weighting of the index on my screen here. So we can see that right at the top, we've got companies like Apple and Microsoft and Amazon that are making up a significant proportion of the index. In fact, if you just go through the top 8 companies, they make up 25% of the entire index, with the other 75% being made up by more than 475 other companies. A good way of thinking about this is if you were going to put in £100 into the S&P 500 as an investment, then around £5.98 of that would be invested in Apple, around £5.35 would be invested in Microsoft, £4 in Amazon, and so on. It's a really easy way for you to get exposure to all of these big organizations. Now, another useful way of looking at this is to look at the industries that all of those companies that make up the 500 are in. Now, we saw some technology companies there like Apple and Microsoft, and the S&P 500 is very technology weighted, with over 27% of the index coming from that one industry alone. And then you can see it goes down and down and down until we get to energy companies here that are making up just 2.3%. So it's a very good way of getting diversified across different industries as well as across different companies. Now, let's take a look at what success the S&P 500 has delivered over the past few years. Now, we are long-term investors. We are concerned about what happens over decades, not days and weeks. And so a good way of looking at that is the 20-year returns that have been delivered. Now, what you can see on my screen here are the 20-year annualized returns. Now, what that means is that if we look at 2020, last year, if you had invested in the S&P 500 20 years before that, so that's the year 2000, then on average, you would have earned 7.47% each year. And you can see that as you go back, it doesn't matter where you start, whether you started back in 1990 to get to 2010, or you started in 1980 to get to 2000, on average, you've always returned a profit. There is not one 20-year period when you will have lost any money. Now, it's important to contrast that with what happens on an annual basis, because over a specific year, then of course there are peaks and troughs. For example, after 2000, there was the big tech bubble when shares did fall. And if you were just investing for a year over that period, you would have lost money. Same with the financial crisis in 2008. If you were just investing over a year, you would have lost money. But when we go back to looking at the 20-year returns, even though in 2000 there was a big hit, it doesn't go negative for the 20-year returns. And even in 2008, when there was that big 20% drop, it does not destroy the 20-year returns. So that is why it is so useful to think about this in a long-term investing strategy. So having looked at the overall performance of the S&P 500, let's dive in to some individual stocks over the last 12 months. Now on the screen here are the top performers over 2020. Some of them you'll be familiar with. I'm sure you've heard of PayPal. You might have heard of Etsy if you're into buying or selling crafts. And of course, Tesla, the electric vehicle company, which was a recent joiner to the S&P 500 last year. These organizations really drove a lot of the growth in the entire index, with Tesla growing over 700% since they joined the index. When we look at the other end, we can see some of the worst performers over the last 12 months. And these are really concentrated around two specific sectors, oil and gas, and then also in travel and leisure. Now, of course, in the last year with the pandemic, travel has really fallen off a cliff. So Carnival, which is a cruise line company, Norwegian Cruise Lines, United Airlines, you can imagine how these stocks have performed so badly. And so if I would merge all of those together into one graph, over on the left here, we have those top 8. And over on the right here, we have the bottom 8. And in the middle, in fact, this looks like a small gap, but actually this is the 480 so other that take you from a growth of 98% down to a drop of 50%. So there's quite a lot in the middle there, but you get the idea that you have this general decline from the top performers down to the bottom. Now you might say, well, can't I just beat the index by just picking the best ones and getting rid of some of the small ones? Well, if only it was that easy. The thing is that the success of the S&P 500 is really driven by a handful of top performers. Now, you've heard of Tesla, you've heard of PayPal, but have you heard of Albemarle Corporation? Have you heard of Nvidia? Well, if you hadn't, then what is the likelihood that you would have picked those to be in your top 10 stocks for the year? If you had not picked them and you'd left even one of these top 10 out and replaced them perhaps with a very profitable cruise line company or an airline last year, then you would have failed to beat the index. Jack Bogle, who was the original founder of the first index fund, famously said, "Why bother trying to find the needle when you can buy the entire haystack?" And that is exactly what you should think about when it comes to an index tracker focused on the S&P 500. Why spend time worrying which of those 500 are going to be the best performers when if you buy all 500, you can pretty much guarantee the returns that your predecessors have seen over the previous decades. With an index tracker fund, you don't need to panic over which hot stocks to choose. You don't need to ask your friends on TikTok what they're investing in. And you don't need to be monitoring every day, worrying about what's going up and what's going down. By putting just £100 into a S&P 500 index tracker fund, you can guarantee that you're invested in all of the top organizations in the United States. You can guarantee that you're diversified across different industries and even different countries, because the S&P 500 companies only get around 70% of their revenues from within the US anyway, which means it really is low risk. For you to lose the £100 that you put in, you would have to see Apple, Facebook, Google, Amazon all go bust. And if that happens, we've probably got bigger fish to fry. So there, in this video, we've taken a quick look at the S&P 500. We've learned that it is a list of 500 of the biggest companies that are based in the United States. We've learned that we can invest in it as an easy way of pretty much guaranteeing to grow our money over a 20-year period or more. And we've also seen that trying to beat the index by just picking the hot stocks can also be one of the fastest ways to lose against the index. Now, you can get started really easily investing in an index tracker fund focused on the S&P 500. Up at the top of the screen now, you'll see a link to one of our other videos where we talk about how to choose an index tracker fund, because there's plenty of them out there. And with just £100, you could be investing in the S&P 500 within half an hour. So what are you waiting for? I hope this video has been useful. If it has, then please do share with your friends and click to subscribe to the channel, because we've got loads of great new content coming over the next couple of weeks. Thank you very much, and I'll see you there.